What do you call a company that borrows billions just to buy Bitcoin, then doubles down every time the market pumps? Some call it genius. Others call it a house of cards. Today, we're diving into the bold, bizarre, and maybe a little bit bonkers strategy of Michael Saylor and MicroStrategy. Or should we say, strategy now? Saylor's been hailed as the patron saint of corporate Bitcoin adoption, turning his sleepy software company into a full-blown Bitcoin maxi megaphone. He's pulled in Wall Street whales, mainstream headlines, and even inspired other firms to jump into the crypto deep end. But behind the scenes, skeptics say his strategy isn't innovation. It's financial engineering on rocket fuel. And if that rocket runs out of gas, well, the landing won't be pretty. Let's start with the basics. MicroStrategy has racked up more than $4 billion in debt, mostly through convertible bonds and stock sales, and used that money to buy Bitcoin. Lots of it. In fact, Bitcoin is now basically their entire treasury strategy. It's not a side bet. It's the whole table. Now here's the kicker. The more Bitcoin they buy, the more the stock pumps, because Wall Street views them as a Bitcoin proxy. That stock surge makes it easier to issue more debt, to buy more Bitcoin, and so on. It's like financial inception, a loop inside a loop. But skeptics are asking, what happens when the music stops? Bitcoin's a roller coaster, we all know that. But imagine being on that ride with $4 billion in borrowed cash and no brakes. If Bitcoin crashes, and it has many times, MicroStrategy's balance sheet could implode. They're not making enough money from their actual business, enterprise analytics software, to service that debt. So what do? They dilute shareholders, issue more bonds, sell more stock. Critics say it's not value creation, it's value extraction. And while Saylor fans claim it's a long-term vision, others argue it's just leverage wrapped in laser eyes. Now here's where it gets spicy. Some skeptics compare MicroStrategy's model to a pyramid scheme, not in a criminal sense, but in structure. You've got a reliance on new capital inflows, hype-driven stock rallies, a self-reinforcing loop that only works if momentum continues. Sound familiar? That's because it shares traits with past collapses. Think Terra Luna, but corporate edition. Every new bond issuance helps buy more Bitcoin, which boosts the stock, which enables more issuance. But it's all built on borrowed time and borrowed money. If Bitcoin stalls or drops, the loop breaks. Suddenly you're not flying, you're free-falling. Here's where it gets existential for Bitcoiners. One of Bitcoin's founding principles is decentralization. No rulers, no kings. But MicroStrategy? They've been scooping up tens of thousands of BTC. That's not decentralization, that's consolidation. Saylor argues he's helping secure the network and hedge against inflation. But some wonder, is Bitcoin really the people's money, if one man can own this much of it? It's like preaching equality while building a throne. And here's the irony. Back in 2013, Saylor called Bitcoin online gambling. Fast forward a decade, he's leveraged his entire company to go all in. Has he seen the light, or just seen the hype? To be fair, Saylor has brought attention, legitimacy, and capital to Bitcoin. He's rallied institutions, spoken to governments, and turned normies into node runners. But the core critique remains. Is MicroStrategy a visionary bet on the future? Or is it a high-stakes pyramid dressed in laser-eyed conviction? Because if the inflows dry up, if the hype fades, if Bitcoin wobbles, then maybe, just maybe, the emperor really does have no clothes. This is part 1 of our deep dive into the Bitcoin whale no one can ignore.